Today's guest is someone who has lived both sides of the entrepreneurial journey, first as CPG founder and now as a restructuring expert. Andrew Kitirattragarn founded Dung Foods, a snack brand that raised $12 million, grew rapidly via nationwide retail, but ultimately didn't make it. He took that experience and pivoted into helping other founders navigate some of the toughest moments in business. Now at Sherwood Partners, one of the most experienced restructuring firms in consumer technology, Andrew works with brands when things don't go to plan, whether that means finding a buyer, restructuring debt, or winding down. In this episode, we dig into what Andrew learned from building Dung, why even great products can fail, and how founders should think about fundraising, burn, and runway in today's environment. We also get into the emotional side of failure and how to prepare yourself and your company to weather downturns before it's too late. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, and acquirers in the space to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Andrew, we're going to take this in two parts. The first, kind of an intro on Dung, your prior brand, which you've been very authentic and public about. And then that, I think, will be a good entree into everything about restructuring and how Sherwood approaches things. So let's do the first part first. You raised $12 million for Dung Foods. You build a beloved CPG brand. What was the original vision and kind of what was the early momentum?
Yeah, thanks for having me on the show. Happy to share my experience. I'd say that there was no exact original vision. My brother founded the company, and our mom gave us Thai lettuce wraps. This was back in 2012, and she gave us a recipe and had toasted coconut as a topper. And he was he was cooking the toasted coconut in his kitchen, and that's how he fell upon this. And that was in 2013. It was during the coconut craze, and so there was a big trend there that we were on top of, and we were the best tasting coconut chip. I was in Thailand at the time visiting and family, and I helped him find some manufacturers to source the coconut chips. And I think an early breakthrough moment was in 2014. Was in 2014 when Safeway took us nationwide, very early. That's when they were consolidated as one entity versus split up purchasing regionally. And that's when my brother called me up and asked me to join full time.
And when you look back on that experience, what were maybe some of the first signs that things weren't going as planned?
We're not going as planned.
That's right.
I think so. One of the things I mentioned is that this was you asked about the original vision. There was not a vision in the beginning because we're just like, this product is really good. The vision was the product. It's like, oh, there's an opportunity here. We had some very Thai like letters in the beginning of like, it's Dung, so it was very rustic. But there wasn't really a vision of what this could be until later. We were just executing on some product market fit that we had. And the product being the coconut chips themselves, like the good tasting coconut chips. Long story short, the trend is, I think our business was built on a trend, but all trends die or fade away. And we were a coconut category creator, and we didn't know how big it was. But it turns out the category never turned out to be that big. The whole coconut chip category, maybe in total, was maybe 20 million, and we had most of that, but it limited our growth. And so that's the first sign, I think, that things weren't going as planned.
And obviously, you've had a lot of time to reflect on this. If you could go back to your former founder self during that journey, what would you say?
I mean, there's a lot of things. It's hard to go back. It's dynamic, right? Because there's every year, there's every day in those years. I probably tell ourselves in building our own category, we want to really think through the risks of raising money without having an established own category, a category that we were building in itself. So I think that brings further risks. In retrospect, and it's easy to say in retrospect, we shouldn't have raised as much money as we did. We could have maybe gotten by with a lifestyle company raising half as much or a quarter as much. I think we were disillusioned by the early success, but those early successes were driven by the trends that I talk about, but it's also driven by distribution and not velocities. So those are just some tidbits.
Yeah. Um, I've probably met a couple of dozen of restructuring folks over my career. I think you're the only one that comes from a true founder background. How does your founder background change the way you work with distressed companies at Sherwood?
Yeah, I think I'm more empathetic to founders and executive teams. I think people that are in my industry and restructuring get into it one way or another. Some people come from the consulting side, some people come from the bankruptcy side. It's all very tactical and executional based on skills. Um, I'm coming at it from a purpose standpoint. Like I want to help others find closure. It's more than just a job for me in that sense. You and I have discussed too. It's like when I had a hard time with distress towards the end of my time with Dang, there weren't at the time and now still today, there weren't that many resources available. There's not that much help available because, you know, shareholders and your board, they might not have the as much of an incentive or might not want to help you out as much, given the distress is just a lot of work for them as compared to their other investments. And also, it's not really something people talk about, Fan. People don't want to talk about like,
All the dirty laundry.
yeah,
Yeah.
if you don't want to talk about the dirty laundry. And so, like, I kind of had a deeper purpose. Like, I wanted to change this. So I'm grateful you brought me on. So hopefully we could change the narrative and have more conversations about this. Um, and so um, I think that gives me a unique perspective into space.
So let's take a step back then, maybe do a quick Sherwood 101 for the $5 million to $50 million revenue founder here. What do you do and kind of how does a typical Sherwood engagement work?
I'm a managing director for Sherwood Partners. Sherwood Partners is a financial consultancy. We have about 30 professional staff working in Silicon Valley, Los Angeles, and San Francisco. I like to say that we're financial experts in helping you think through Plan D in the worst case. We do alternative bankruptcies, ABCs, assignments for benefit of creditors is a big thing that we do. It's a vehicle to wind down. We also do other managed wind downs. We also help out as a financial advisor in bankruptcies, and we do restructurings. The engagement really depends, and it's when you give us a call, we can provide advice on your situation, but I also recommend like the right tool for this situation. So
AI. Everyone's talking about it, and you're worried you're getting left behind. Meet RichPanel, an AI-first customer support platform that's built for one thing: making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. RichPanel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, powered by GPT-4, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with RichPanel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgeous, 30% automation to reduce your ticket volume, and a no-risk guarantee that if RichPanel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using RichPanel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, real AI that actually works. I think one of the things that we see is maybe thinking about Plan D too late. You know, they've got Plan A, Plan B, maybe a Plan C, but they really don't want to think about Plan D. That's too scary to think about. They don't feel like they'll ever get there. And then they end up getting to Plan D too late. How early should founders and management teams think about Plan D, start talking to a restructuring advisor? Are there kind of clear signals that they should be?
yeah, I feel like 3 to 6 months of one way is accurate. And keep in mind too, you might have an estimate of 3 to 6 months, or oh, I only have 5 or 6 or 7 months. But there also might be like critical fiduciary reserves, like payroll, like last days of payroll, like severance, like sales tax, other items that you're not accounting for runway. I'm just saying your runway might actually be less than what it is. Um, 3 to 6 months, I think, is good. Definitely at 3 months. 6 months is good. I recommend at 6 months if you can, although not everyone can, but if you can at 6 months, and I really think it helps from a psychological perspective. Like if you're coming to your board and you're signaling to the board, hey, like just we have 6 months of runway with, I had a call with some restructuring advisor, I had a call with Fan, I had a call with Andrew. Here are some things that it might look like. I think it's a really strong for your fiduciary duty to do that. I think your board will be impressed. And I think that it's not well, only your board will be impressed, but I think it'll give you and your board peace of mind. And I think it'll help you execute a little bit better during this time and trying to save your business. Like when things were tough with Dang, I remember turning to my brother and telling him, um, hey, let's not call this Dang Foods Company. Let's not call this after Dang was our mother's name in Thai. Let's call this the ABC Company because it's important that we stay objective, like while a lot of chaos is being thrown at us. And I think that it's you can get to that more objective approach earlier if you start thinking about this earlier.
And just to kind of put a finer point on that, if someone with 6 months of runway gives Andrew a call, I imagine you're always happy to take that call, but you're typically not getting engaged and they're not paying fees, right? They might have an intro call and then like 6 weeks later, they may touch base, say, hey, Andrew, like runway hasn't been extended. We're still short. Then you might start thinking about a scoping call. And it probably is maybe at the 3 or 4 month mark where they're like, well, shoot, maybe we actually want to, scope out an engagement letter because we may need to go down this route.
Yeah, and like I'd say too that there's a lot of calls that I have where the engagement doesn't work out with us, and one of the reasons is because um we are a premium boutique shop, so we're not cheap, and it is what it is. But I still that still doesn't kind of get me away from my purpose, and so I still want to be able to have the calls. I might be able to give you a couple pointers or point you to other people that can help out more actively if that doesn't work out. I found it useful, and or sometimes I have calls and I just like give them an emotional pep talk. Some founders, and I know that they can't afford my services, but some people really appreciate that too, and I'm happy to do that, and that makes me happy. That makes me um, remind myself why I'm doing what I'm doing.
Yeah, no, that's awesome. Maybe what are some like common mistakes founders make when they first realize they're in financial trouble? We talked about kind of maybe leaving it too late, but are there other things that you're like, other advice that you'd have for the audience?
I think it's tough because it's like there's so many things that could look like. So when you're in financial trouble, ideally you've done some thinking before you're in financial trouble and thought through, and it's not a surprise to you. But I understand it's startup and things change and the world changes. Like I think having gone through my restructuring background, having gone through the distress, I very carefully think through contracts in like a worst case scenario because I see it all the time. And not just contracts with your vendors, but your financing contracts too. Like what does it look? What does dilution look like in a down round? Um, I think most people don't think of that until they've gone through it. And part of it is the entrepreneur's dilemma because you're supposed to be so positive and optimistic and knock down doors. It's almost like you want to spend your time focused on the upside and doing everything for the upside and not as much on the downside can be a downer. And by the way, my brother and I had a good mix. We were co-founders, but I was always more focused on the downside and he was focused on growing the startup. Um, the other thing I'd say too, associated with that is like, you might not be able to see around the corners. And so it's important that you build relationships early on so that you can call people when these hard times come or bring on someone to your board. Like I think we brought someone really impactful to our board in Amit Pandi a while ago, early on, and he was like my first call when things were troublesome, and he really helped me see around the corner. So I'm very appreciative to that man.
Yeah, I think speaking to the contracts and financing agreements, I think it's not that uncommon that we'll talk to a founder and ask, hey, which of your three security agreements are personally guaranteed? And they're not sure. Or sometimes they'll say the one that is personally guaranteed that they think that isn't, or that they'll say, actually, I think all three of them are. We're like, actually, no, that's not the case either. Some of them aren't. And Yeah, that entrepreneur's dilemma is very real, that it requires all the optimism to get it going and to be believing in that growth phase. And it's kind of impossible to switch that, where you probably need to turn that off in that last season.
100%. You turn on, or you just know you don't have it, and that's okay because you're supposed to like break down doors and be optimistic and do that for the team and do that in front of it. You're supposed to not be as risk conscious, but bring on somebody on either full time or in an advisory role that thinks the other way, and that could think through that.
Yeah, no, that's great advice. Having a trusted thought partner that can be a counterbalance to the reality of the situation. Maybe let's take out the Sherwood filter of all the CPG and e-commerce brands that you may have chatted with over the last, let's even say, 3 years. What are kind of the common outcomes? Manage wind down, asset sale, recap. I don't know if you end up tracking all the ones that you initially speak with, but maybe we'll just educate the audience on what are some of the options, what are some of the outcomes.
I don't have the exact data on this, but I'd say that just in general strokes, like usually, um, what we see is that for a CPG e-commerce brand, if you've raised a total of like $10 million or less, that you're most likely, I think, depending on if it's a more simple wind down, it's either going to be a managed wind down where you do it yourself, or there's an advisor that you hire that comes and helps you do it, alongside maybe bankruptcy counsel. That's more or less what we did at Dang. For the Dang entity, again, we sold off the assets so that the brand continues onwards. Um, if you've raised like more than like 30 million, you might have some buffer left over. Your boards might have required you to leave some monies behind to have a smoother wind down process where you can afford something like an assignment for benefit of creditors, where you're giving the keys to a trustee like us, but it's an out of court process that it's not public, and it can result in a higher monetization for creditors. Um, so so if you can afford it, people can go with the ABC route. If you can't afford it, maybe a managed wind down. Another option as well is a Chapter 7 bankruptcy as well, which has its benefits. It's not as smooth as an ABC because it's public, and the trustee might not be as experienced as us, or they might not sell the assets as quickly as us, but it is an option.
Cards on the table. Your tech stack is held together with duct tape and prayers. If you're a brand founder or COO juggling Shopify, your 3PL portal, 3 different inventory trackers, and yes, that one crucial Google Sheet, you know exactly what I'm talking about. Orders get lost, inventory counts are fiction, and your seamless integrations break every other Tuesday. Endless Commerce changes the game. One platform for everything. D2C, wholesale, marketplaces, the works. AI-powered forecasting, real-time inventory visibility, and integrations that actually integrate. Teams like Great Jones, Food 52, and Pattern Brands already made the switch. So ready to ditch the chaos? Visit endlesscommerce.com. Mention me or In the Money when you reach out and get 3 months free. Because your ops stack should be your competitive advantage, not your biggest headache. The managed wind down, maybe let's just spend a minute here, because I think that a good portion of the audience might be in that bucket. So the core team is, you've got the founder working with a restructuring attorney and kind of help them avoid some of the landmines. Maybe that's enough. Maybe they had add a third person, which is a restructuring advisor that frankly charges a lower hourly rate than the bankruptcy attorney. And so maybe a better first line of defense. And the cadence is communicating with creditors of this kind of next step of the company's journey, which is the wind down, and saying, hey, you're receiving all these creditor notices. You're probably getting emails at least every week, if not every day, if not multiple a day. And you're telling them, hey, we are doing a managed wind down. Your credit has been recorded, and we will try to sell the asset and then distribute funds based on the waterfall. Is that kind of directionally right?
Exactly. That is the exact messaging, more or less. And then I call it the keeping it real communications, where you're full transparency on what's going on. You might have to take a look at your creditor stack to understand who owes what, and the more material ones, you probably want to get a sense of their willingness to cooperate or not cooperate, because that might determine your approach on whether or not you can do a managed wind down, do a bankruptcy. But yeah, that communication is a huge part of that, and it's kind of like, oh, I call it like the keeping it real communication. Um, yeah.
And I guess there's a really critical part, and this is the impossible question to answer, which I'll ask you anyway, which is like, when do you end up turning it off? Right? Like, when do you turn the kind of the monetizing asset off, whether that's selling into retail or selling online? And because initially you want to monetize the asset by selling it and accruing some funds that then gets distributed to creditors. But if you ultimately can't find anyone to sell the asset to,
So I'll just tell you what we do at Sherwood. We do sales processes for most of our deals. So for most of the deals into ABC where you hand us the keys, we do a sales process if a sales process hasn't already been done. So there's some instances where we do a sales process outside of an ABC, but it's usually a distressed situation. What we do is we have something called a date certain sales process, and we do this. You guys can do this too. You can you can figure out how to do this too. But we do this like I've probably done like 30 of these. Um, it's usually a 4 to 6 week process, and at the end of the process is date certain. So that means that I don't know, on September 15th at 5 o'clock Pacific time, we will be gathering all the offers in terms of a red line to the asset purchase agreement, and going from there. And then after that, we get all the offers in, and we look to close within the weeks after that with whoever the winning offer is, and then it's done. And that probably needs to be managed coincided with, well, how many, maybe it makes sense because you're in distress to not issue any more POs, but maybe you still have enough inventory for 1 or 2 months that will be adequate enough for the sell through period to transition over to somebody else. And then you go all in and give it your all for those 6 to 8 weeks. And then there's closure, and then you move on, and you either have an offer or you don't. That's the process I recommend. Um, Otherwise, you just be in limbo. And I do see this, I think, sometimes from founders and from boards. That's like, oh well, there's a kind of a hesitancy. Um, but also every day that goes by, your brand is going to be losing potential value, given that you're in distress and might not be able to order more POs or support with a sufficient sales or marketing or ops team.
and then you're also risking that, as time goes on, you're potentially going into deeper insolvency.
Yes, it's not like you're going to wake up and magically like something's going to get fixed unless you have an agreement from or a funder that's gonna backstop you. But for the most part, you're not. There's not going to be a magic wand that happens. You have to. The beauty is that you can create it with the process that you with your own work, or we can do this too. So we would guarantee that we're like, I can't guarantee what number we're going to get for you, but I can guarantee we're going to run a really robust, 100% robust process. And by the end of that process, the market will have spoken.
But like you said, that limbo is probably the default, because it's hard. It's so hard to be rational when there's so much emotion tied into it, that often there is inventory, and then you can just keep going for quarter after quarter for a year, 18 months, 2 years in this limbo state. And we've seen that, certainly. And you're just kind of playing creditor roulette. But your view, kind of with all the experience that you have, is saying, okay, have a rational person in the room and then run a time boxed process, because balance of probabilities, it's probably not going to just magically turn around.
100%. And I would say, I maybe edit the word rational, say have someone with a very different skill set, like a skill set that is very risk averse, and maybe is as skills as in finance or in distress situations, or as a fiduciary in particularly in distress situations. Because the skill is different. Like the skills that got you the money that you raised are can't be like more opposite than the skills to wind down.
Yeah. Sticking with the kind of hard questions, how do you think about balancing creditors, investors, and then founders in a restructuring process?
Yeah, it's quite easy. So I'm just putting myself in the founder's shoes and management shoes or an executive shoes here. In insolvency, when your assets more or less are less than your liabilities and you can't pay off your debts, and your fiduciary obligation legally extends to your creditors. And arguably they're maybe the most important. Your creditors are maybe more important in terms of a fiduciary obligation versus your equity holders because they are the ones that are out of the money. So when we come in as a trustee via or what we call the assignee and an assignment for benefit of creditors, first and foremost we report to the creditors. As assignment, it's in the name. It's an assignment for the benefit of creditors because they are the ones that are out of the money. Now, if a sale process happens and it gets sold for $10 million or more and it beats the creditor stack and then we pay back, well, now we're getting into the investors and we become an assignment for the benefit of investors too. But that doesn't happen that often because we're usually in these plan D situations. So in terms of like, I think one benefit that we're providing to everyone, which is why I came to this, is closure to everyone. The real economics are that we're first and foremost providing benefits to creditors in the situation of an insolvency. And even if you're not in an ABC, you're still supposed to be, you still, the CEO or the founder still has a fiduciary duty to do that in these situations, to keep the creditor in mind in these situations, in the very least.
If you're like most founders, supply chain is probably one of those things you just deal with because you have to, not because you love it, and not because you're an expert. If you spend hours chasing suppliers, negotiating tiny price breaks, trying to figure out if delays were real or just another excuse, you probably want to pay attention to this next bit. Move Supply Chain is a team out of the Philippines I've been working with, and they've saved me hours I didn't know I could get back. They handle the messy stuff: sourcing, supplier vetting, negotiations, tracking, and even inventory planning. They've helped D2C brands I know lock in better MOQs, negotiate stronger supplier terms, and make smarter decisions with working capital. What do I like most? They don't give you a deck and disappear. They actually embed you with ops and fix things that are slowing you down. Now here, a bonus for listeners. They're offering a risk-free 4-week trial. You can use code INTHEMONEY to get a discounted rate if you want to test them out. Anyway, if Q4 is starting to feel a little too close for comfort, check them out. It's one less thing to deal with, one more thing you can upgrade to an expert level. Website's movesupplychain.com. That's movesupplychain.com. We talked about kind of maybe limited TAM or kind of too much equity. But you've seen behind the curtain on dozens of distressed brands. Are there kind of common patterns you may see again and again as to why things don't work out?
I haven't gone into a deep dive as to the why. We get a lot of business in here, and we're not really supposed to dive into the analysis as much. Just we take what it is, and there's so much work to be done executing a smooth wind down that we don't really take a step back and really analyze the why as much because frankly we're not paid to. But that being said, I mean I have to think, and this might be I mean you talk with a lot of other people in this space that might know more, that are like more in tune with it. I mean I do think timing and trends is such a big part of it. Like whatever your equity stack is, whatever you've raised, like coconut chips were super hot in 2013 through 2015, 2013 to 2016. That didn't last. Like alt meats has had its day, and I talk with alt meat companies here and there. So it's and it's a lot of it's trends, and I guess what my message is, I hope founders don't take it personally. Like there's a TED talk about this. There's data that shows that startups, the number one reason why startups fail is due to timing. And I think my advice to those founders, in particular, like if you're a young founder too, if you like, the goal should be to take as many shots on goal as possible, right? So if you failed once, you're still young. You just keep going. If I were to do it over to startup, if I weren't, I would probably limit myself to 5 years in a startup unless I started really crushing it. But if I'm not getting traction, I would probably continue on with my next thing. You want to get as many shots on goal as possible throughout your lifetime.
Yeah. And that part, it's so hard to see, right? Because You could be in year 3, you could be in year 4, and you're like, you're always 1 year away. Because there's also all the other stuff that you hear online where you're like, you're just one ingredient change, you're one packaging
But
change, you're
yeah,
one funnel optimization change away.
the problem with CPG is that you're operating at a very low margin structure, sometimes at a negative margin structure, right? So it also depends on your margin structure, right? If you have like clear profitability and you have a moat for a little while, then you can, even if you're not crushing it, you still have some downside protection. But in the event that you're losing money or close to even break even, where it's not so comfortable, it's not as big of a luxury you can have to kind of just wait it out.
The ability to generate, positive contribution margin is certainly a factor, but I think even to your early point, it's something I so agree with, that time boxing it from the beginning and saying, kind of disagreeing with it, like, oh, it can take a decade for it to start working. But I'd even potentially shorten it from 5 years to 3 years and being like, hey, I need to see really clear PMF or positive market signal that we are ripping with good margin structure by the end of 3 years. And if not, like, it's probably not going to dramatically change in the next 2 years. And so I'm better off just having a new shot on goal.
100%. I also agree with that. That it actually probably gets you aligned with VCs, where uh, maybe they're looking for. I mean, CPG is probably a little bit different, but maybe they're looking 3 or 4 out of 10 to win, but to return 3x plus or maybe 5x plus for those 3 or 4 to win. So I think that they would actually be aligned. That actually probably aligns your incentives with most VCs as well. And I'd say another thing I'd say too is that, like, I still have friends in the industry, and I think I don't go to the shows as much anymore. But I think the last time I went to the shows, I went to go see some brands that were kind of formed around Dang Stage, and they're still around. And I don't know exactly how well they're doing, but they're still around. I don't know if they're not publicly crushing it. Like, they're not like, I don't think they're close to being acquired like a Poppy or something like that. But they're kind of, so I'd say that there might be middling around, but I could be wrong. But I remember, like, I think talking to some of them, I I thought they were just really tired. And I think that there's this, like, hey, I'm going to stick in it to win it, mentality. And I question if that's right. Um, and by the way, that doesn't mean that necessarily you as the founder need to wind it down. Like, if it's still like, if there's still some opportunities, there's still some profitability, there's a chance there. Maybe there's an opportunity to bring somebody else in. Um, but and I'll tell you too that, like, I've learned so much in this industry at Sherwood over the last few years that I'm like, that would have been a big opportunity I gave up if I stayed with Dang for the last few years.
Yeah. Yeah. No, that's in itself a really important point, that, catching up with founders who did end up winding down, catching up with them a year or 2 years later, and they're now an executive at a high growth company, or they're doing something like you are and crushing it on the other side. That so often we end up talking to founders that are in this kind of limbo land, and they either can't see past this opportunity, or they say, hey, I don't have my next thing, and so, like, I'm just going to keep going. And I think the answer is actually, you don't necessarily need to know what the next thing is, just having the time to think.
I think it's important to have the time to explore. I mean, I know it's a luxury. Like, I know some people have babies to feed and families to feed, so not everyone could do it. I was privileged enough to have the opportunity to have several months where I could explore, where I went to the Turnaround Management Association and I met with a bunch of people, and I met Marty, who brought me into Sherwood. I was able to kind of peel back that interest and that passion. Not everyone has the luxury of doing that. Um, the other thing I'd say too is, I mean, if you're thinking about that, sit down and really think it through. I guarantee you could think of maybe 10 potential opportunities for yourself. There's so many skills that you learn as a generalist CEO that could make you applicable for other things.
Other kind of landmines or squirmy parts of the wind down process for founders that kind of you see that founders should be aware of if they're in this kind of zone?
I think you nailed it on the head. I think the biggest part is psychological. Um, and I get it. Like it's your baby. It's your baby, and uh, no one likes going through that. But I'll tell you that the people that I've helped to wind down the founders that I've helped, I do get calls like 6 months, a year later, telling me that they're very thankful that I was with them during hard times, but that they're like thriving and they're like super happy and much happier than they were in
Yeah.
the months and the years leading up to that moment. You nod your head like it sounds like you've had similar experience. Like it's like I get that. People are like, hey, like it was important for me to go through that, and now like I'm thriving.
Yeah. Yeah, totally. It's so hard to see in the moment, but there certainly are opportunities on the other side. Andrew, as we head towards a wrap, is there anything that you're seeking from listeners, brands, operators, collaborators? Where do people find out more about Sherwood?
No, I mean you guys can shoot me. You can see at our website. I don't even remember our website. I don't think our website, by the way, is Sherwood.com. I think we were too cheap to buy that. I think it's like SHRWOOT or something like that. So you can Google us, Sherwood Partners. I'm sure you'll find us. You can contact me. Again, like I'm just saying, like I'm more than happy to take a first call with people. Like I really want to push people in the right direction, um, and be supportive where I can be. So, but I'm not looking for anything in particular. But happy to. I enjoy helping out where I can.
Andrew, so much respect to your purpose and everything that you do for companies at this stage. Thanks so much for coming on and sharing the knowledge, and look forward to next time.
Great. Thanks, Dan.